Hi, my name is Brittany Riley, and I'm an attorney at Doyle Quain in downtown Danville. Today, for the Women's Enterprise Initiative through the Danville Area Chamber of Commerce, we're doing a session on succession planning. We're covering everything from corporate governance and entity formation through succession planning and estate planning. There is a very, very, very good chance that at some point during your life, during your career, you will have some sort of temporary transition. So you will have a incapacity. That's a word we use a lot in estate planning. That just means you're not currently able to manage your own affairs. So somebody else needs to step in and manage them for you. We think about that a lot with estate planning because if you have bank accounts, other financial accounts, your house, if you're incapacitated, who's going to kind of keep everything rolling while you're incapacitated? And that's what we're planning for. Let's go to choice of entity. I don't want to spend too much time on this one because this is really relevant at a very small moment in time. So sole proprietorship. A sole proprietorship is where a single individual owns and operates the business. They have full control, full responsibilities, but they also have full liability for it. So there's no separation between you and your business. And your taxation, it's all on your personal tax returns, but no liability protection. The next is partnerships. So partnerships, same sort of idea, but there's more than one person, right? Kind of right there in the name. This GP and LP, a GP is a general partner and an LP is a limited partner. So general partners, again, full liability, but we do have limited liability partnerships, which is kind of like a little hybrid between an LLC and a partnership, where for certain of the members, they don't have the liability. Taxation, again, pass through, so it's going to each individual's own tax returns. Limited liability company, this is probably the one that most people know the most about or are most comfortable with, familiar with. It's something that a lot of people use as a tax planning tool. LLC, a little bit more formality, right? We're registering with the Secretary of State. You're making filings every other year with the Secretary of State. You do have liability protection. Again, this is kind of corporate governance 101 or entity choice 101, but in case anybody doesn't know, the whole way the LLC is working is whatever you're putting within the LLC, that's the extent of your liability. So we use these a lot in estate planning for things like rental properties. You're renting out your second home, so we put it into a limited liability company. That way, if there's a slip and fall on the property, the only thing that person can get after if they sue you is whatever is owned by the limited liability company. So it's just the house, meaning your personal bank accounts, personal home, all of those things are not subject to attack in that lawsuit. So we use these all the time. They're great. We love them. Then there are corporations, S Corps and C Corps. Corporation is a much, much more formal entity. We use them when there's, a lot of times when there's an idea that there may be an investor in the future. They're much more investor friendly. I'll kind of go through a little bit of that later. The difference between an S Corp and a C Corp you'll see is right here in the taxation. So the S Corps we love because you can pass through that taxation. You don't have the corporate double tax. But sometimes you can't qualify as an S Corp for a number of reasons. This one is one that is for sure cocktail party knowledge that I did not understand before I started doing this. Why the heck does everybody incorporate in Delaware? What is so great about Delaware? The reason that so many of our well-known corporations are formed in Delaware is because Delaware is very, very business friendly. They have a special court, it's called the Court of Chancery. And the Court of Chancery knows business inside and out. So it's really stockholder friendly. Investors love it because it's really predictable. It would be hard for a venture capital investor to invest in California entities, Nebraska entities, Florida entities, and keep up with the different laws in all those states. So it's a really nice kind of organized system that our kind of mainly investor-backed companies are all formed in Delaware. The Corporate Transparency Act is the Department of the Treasury's Financial Crimes Enforcement Networks, FinCEN is what we call it. FinCEN is trying to get a grip on people who are using LLCs. What the Corporate Transparency Act does is it says, hey, if you have less than $5 million of gross receipts in a year, you need to make a filing with FinCEN saying who actually owns that LLC. Every entity that has less than 5 million in gross receipts, and there's some other kind of asterisks on that, needs to make a filing with FinCEN by January 1st, 2025. But if you have an entity that's filed with the Secretary of State, make sure you check into whether you have to comply with this. And if you do, it's really easy to comply with. It just has to be done by January 1st of next year. All they're asking for is who owns it and where do they live. That's all they want to know. You have to upload your ID. And then every time you move, you have to do it again within 30 days of moving. So we're going to talk about estate planning, because estate planning, like I said, is kind of our way of doing some succession planning. We're doing estate planning to plan for these transitions like I talked about. We have to make sure that there's an action plan for you while you're alive and for your family once you've passed, to have a plan for that transition. 46% of American adults apparently have a will, according to Gallup. In California, we are doing our estate planning for a number of reasons. The primary one is probate avoidance. So we're going to go into what probate is and why we all should try so hard to avoid it. The other reason we do it is for personalized planning, and that's the most relevant when you're thinking about business succession planning, is the California default for transferring assets upon death and for management of assets when you're incapacitated just doesn't work for a business owner at all. And the last is peace of mind. This is often the biggest one for families, right? Making sure that there's a plan in place so that your loved ones know what you want to have happen during these periods of transition. So probate, kind of quick definition, it's our default, right? So if you don't do any planning in California, or if you're part of that 46% of Americans and you just have a will, you don't have a trust, probate is going to be something that you will become acquainted with. Again, quick definition, it's our court-supervised process of validating a will, appointing a personal representative, and overseeing the distribution of assets to the rightful heirs. How does the probate process work? A probate process, very briefly, I'll touch on, if you're incapacitated and you don't have a durable power of attorney, we go to the probate court and ask them to appoint a conservator to manage your affairs while you're incapacitated. Today, I want to focus primarily on probate upon death. So this is when somebody's passed away, and again, they just have a will, or they have nothing in place at all. They've done no planning. So we have assets in this person's name, and we need to get those assets from that person's name to the name of their legal heirs. This one is Mr. Avila, and this is all public filings, right? I'm not breaking any confidentiality by sharing this with you because this is all in open court. So this one I'm showing you as an example of one that went very routinely. So Mr. Avila passed away, you'll see June 8th, 2021, and you'll see the date. This petition is what I file at the end. So you'll see he died in 2021. We finally got our day in court to allow that final distribution on March 19th, 2024. That's about standard. This one went, like I said, very smoothly. The personal representative was appointed. In this case, Mr. Avila died with 4 children. 2 children were estranged. He hadn't talked to them in decades, I was told. 5 children. The other 3 lived with him, very close with him. But probate code says everything divided 5 ways upon death. So we had his son, Jose, who goes by Tony, appointed. Again, Tony waited about a year to file, so this is about 1 year longer than it looks, 1 year shorter than it looks. It says a final inventory and appraisal of the estate was filed in March 2023, showing assets having total appraised value of $727,000. The court doesn't just take our word for it, right? So what you do in a probate proceeding is a probate referee is appointed by the court. This is a person who is an estate planning attorney or a realtor or some sort of other professional. They're appointed by the court to go in and appraise all of the decedent's assets. So we do that inventory and appraisal process. At the same time, we have the creditor claim process going on. So what that is from the date the personal representative is appointed for a 4-month period after that, the creditors have a right to step up and say, hey, Mr. Avila owed me some money. And then after that, we have everything appraised, we have everything kind of marshaled, we've paid off any creditors, paid any taxes. You can see this final petition is a checklist of everything we did. We do an accounting, so if you flip to the back, you'll see every penny in and every penny that went out of this estate is reported to the court. The court does go through it, and they will ask us questions. And then we start talking about, all right, who gets what? The number one reason clients hate probates, other than the fact that this took 3 years, is the cost associated with it. This is our client, Miss Hunt, administering the estate of Mary June Rose DeGennaro, who lived in San Francisco. She lived in her house with her son. She had 2 other children, but her son lived with her, and her son went through the effort of converting her house into a real-life replica of the Star Trek Enterprise. When the probate was started and it was revealed to him that the house would be sold and the assets distributed 3 ways. So we started trying to get him evicted from the house, but there was a moratorium on evictions. We had to sell the house subject to a squatter. So hopefully I've scared you enough about probate. It's interesting, it's very well intentioned, but the process is just not enjoyable, right? This is kind of probate by the numbers. 12 to 18 months, that's what it should be taking. We've had a COVID backlog in the courts. If we're asking for court hearings, they're giving us dates of like 6 months out, but that's getting better. So when it gets better, it should take about 12 to 18 months for a probate to go through. $23,000, that's the attorney's fee on the first $1 million of estate assets. And then roughly you can add $10,000 for every $1 million above that. And then 100%, that's the number of probate clients who have complained to me saying they wish their loved one had done some better planning because they hate everything about the process. So estate planning is how we opt out of that. If you think about estate planning, a lot of people are kind of intimidated by it. They think that it's something that's complicated or just for the wealthy. It's really not that complicated. This is the entire concept of estate planning in 2 slides. So this is you. You have your real estate, financial accounts, business interests, any personal effects, right? You own all of those in your individual name. So that's our problem that we have to solve. Because if you become incapacitated or upon your passing, they're in your individual name, but you can't manage them anymore. So we have to ask the probate court to manage them for you. So how do we opt out of that? We just take those exact same assets and we put them in the name of your trust. The trust is a revocable trust. It's still owned by you. So nothing changes. The only thing that you really can see a change in is when you log into your accounts online or when you get your property tax statement. It says, the Brittany Trust instead of just my individual name. Other than that, no tax differences, no separate tax filings, anything like that. You can change it as many times as you want. It's just our little loophole, right? Because now, upon your incapacity, we're managing that in a law firm office. And upon your death, same thing. We don't have to go to court unless a mistake was made or there's some sort of dispute. What is an estate plan made up of? The core documents, it's that revocable trust. We also have your durable power of attorney. That's really important for managing things while you're incapacitated. So you have some accounts like your retirement accounts that we can't put into your trust. We can make your trust a beneficiary, but we can't put it into your trust. So your durable power of attorney is the person that can step in and manage those when you no longer can manage it yourself. Who makes medical decisions for you when you can't make them for yourself anymore? We do a nomination of guardian. So if you have minor children, who's caring for those kiddos in the event you and the other parent can't do it anymore? And then asset transfer documents. So there's a heck of a lot of documents that we need to get your assets into the trust. So here's the estate plan process. We draft the documents. Like I said, they're long, but they're not complicated. We're just saying, okay, I hereby give everything to my trust, and here are my rules. If I'm incapacitated, here's who steps in. Upon my death, here's who I want them to go to and how. The next stage in the process is we've set up this trust, but it's kind of like an empty bucket. You set it up and it has all these beautiful instructions. We've thought it through a lot, but there's nothing in it. So we use those documents that I talked about and we fund your trust. We transfer assets to your trust. That's the most tedious part of the process. If you're incapacitated, A doctor writes a letter that says, she's incapacitated, she can't manage her own affairs anymore. We staple that to the back of the trust, and now your successor trustee manages your trust assets. And then upon your death, the trust goes from being a revocable trust to an irrevocable trust. So your decisions are locked in as of that date, meaning you could have changed them a million times. You're mad at one child and cut them out, but then they're good to you again, so you put them back in. That keeps me in business. And then upon your death, it's locked in. And then your successor trustee just steps in and follows the instructions. They go to an attorney. The attorney reads the trust and says, okay, everything's divided 3 ways, and let's go through the steps and do it. Once all the steps are taken, we just distribute everything out. Again, if everything's done properly, we don't have to go to court. Nothing like that is ever filed in open court. 2 to 12 months, that's the average time for trust administrations. Big gap there, right? 2 months would be like you have one child, all going outright to that child. We just distribute it out. Takes us about 6 weeks to get the death certificate, and then we can get it done. 12 months is probably closer to normal because we have to do the final tax returns. And so usually we have to wait until the final tax return is filed. But the actual substantive work of the trust administration is pretty darn easy. I pulled this from Google. The average cost of an estate plan in California, $2,000 to $4,000. In Danville, the fees will be closer to the $4,000. Outside of the Bay Area, it'll be a lot less than the $2,000. There are online trust companies. There are some estate planning attorneys who say, yeah, go for it, pay me now or pay me later, in terms of whether you should use an online trust company. I don't feel as pessimistic about them. I think there are some good products out there. I like Trust and Will a lot. It's very user-friendly. Just think that if you're at a certain asset level, it's a little bit scary to transfer assets to a trust that you set up yourself without having an attorney look over your shoulder. So it's worth the investment, in my very biased opinion. And then 50 to 90%, this is often quoted as what you normally save on a trust administration versus if the same set of assets went through a probate. So 50 to 90% is the average savings, meaning there is still some cost for a trust administration. You have to get CPAs, attorneys, and other professionals involved to get the assets down to the next generation. That's just a fact of life, but it's a heck of a lot cheaper and easier than going through the probate process. Who needs an estate plan? Oftentimes people come into our office when one of the first 2 has happened. So either they have a minor child and they're worried about what's going to happen to my kids if my partner and I both pass, or they're a caretaker for an elderly parent, and they think, okay, if I were to pass, what would happen to my parent? There would be nobody to care for them, and I want to make sure there's ongoing care for them. So that's often a trigger for people, and that is an important time to do it. Homeowners, we're not going to get around probate if you own a home, because again, you could have a $2 million home and a $1.9 million mortgage, and in the probate court size, you have a $2 million home. So if you are a homeowner, you will be going through probate, so you definitely should set up a trust. Business owners, important for this group, but also really important in this area. We have a lot of family businesses around here, and it is very, very hard to transfer businesses from one generation to the next through the probate court. It does not go well. If you have $184,500 or more to your name, you should get an estate plan. Why? Because that's the trigger for probate. If you have less than that amount, we can do some little tricks to get you out of probate, and we do that pretty regularly. But if you have more than that, you definitely need an estate plan. How does this all relate to succession planning? So succession planning is something that we're doing in estate planning in a couple ways, right? So we're thinking about those transitions again. But in terms of a business, we also have some other permanent transition options, right? We have a sale or winding up of your company too. And so there's a lot of planning that needs to be done for those as well. And we do this all really through the estate planning context. The Social Security Administration reports that 25% of 20-year-olds will experience a disability before reaching retirement age. That's a huge number. So when we're thinking about succession planning in your business, we're not just thinking about that sale or what happens upon your death. It's if you have a critical role in your business, what's going to happen if you're temporarily disabled? Who's going to step in? Who knows what to do? So things that we think about for our clients when we're thinking about temporary transitions is, are your governing documents drafted in a way that allow you to have coverage during that kind of time? So if you have bylaws that say only the CEO can sign contracts, if the CEO is temporarily disabled, what's the plan? Is there some sort of emergency clause that says if the CEO is disabled, the president of the board or a designee of the CEO is allowed to step in and do that? If not, we're in some trouble. So we have to make sure that there's good delegation of authority in your governing documents. Your estate plan. So the reason we just went through probate and estate planning is because individuals at their core are the owners of businesses. If you don't own your business through some sort of estate planning vehicle, so through a trust or through an LLC that's owned by your trust, you're just an individual owning that business. So if something happened to you and we needed to step in and get access to the business bank account or something like that, we would have to go to the probate court and ask the probate court to help with that.
Yeah, question. So I guess if you had a will set up, then even when that death were to untimely happen, right?
Yeah.
Does that mean that it can still go to probate even though you have, so yeah, you have.
Yeah, wills are just instructions to probate courts. So probate courts read wills, and it doesn't get you out of it. It just gives, you can give some more specificity. And wills will not help you in the event of this temporary incapacity, right? So your durable power of attorney will, and that's why for a lot of my younger clients, if they're not ready to do their full estate planning yet, I'll say, hey, at least get your durable power of attorney in place, because then you're covered in the incapacity scenario. And the durable powers of attorney are online. You can print out California statutory durable power of attorney, have it notarized, and then you at least have somebody that can step in. But yeah, if you just have your will, it's probate land. Pretty useless. It's honestly, we have a lot of people come in and say, I don't want a trust, I don't want to pay for a trust, can you just draft a will? We won't do it, not because it's a money grab. It's malpractice in our opinion, because it's guaranteeing a huge fee for us when that person dies. And then durable power of attorney. So we just covered this. Thank you, Sam. So this is important for a temporary situation, right? So durable powers of attorney can do things like sign tax returns. So if your business tax return needs to be signed and you're the only person in your business that can do that, your agent under power of attorney can do that. And think about that too. If you're not a business owner, but you have a role at your business, that you have those sorts of responsibilities, and there's not good governing documents covering for what happens if you're unavailable, durable powers of attorney could be very, very important for you too. 70% of small businesses do not survive to the next generation due primarily to poor succession planning. Even if you have a perfectly drafted estate plan and succession plan, if you don't do it properly, it's not going to work out well. So when planning for permanent transitions, is your corporate house in order for ongoing corporate governance? If we're thinking about, I had a client a couple weeks ago, sole proprietorship, and I was asking him, saying, I really want to sell my business, so I think I'm going to convert it to some sort of entity because I don't think anybody will buy my sole proprietorship. And I was asking him, where are your accounts and where are your tools and contractor? Everything was a mess. And so we had to talk through, okay, what do your contracts look like with your customers? He said, oh, I don't have any. So there wasn't anything there that we could sell because nothing was really properly organized. So this is really important. When you're thinking about, okay, I want my kids to be able to make some money off of what I've done, even if they're not going to take it over, what is it that could actually be sold or you could get some liquidity out of? The biggest conversation we have when we talk about succession planning, when we think about, especially if you want some sort of key employee to take over your business for you. So kind of The fallback position people always think about as succession planning is some sort of heir going to take it over. That's often not the case, right? There's some sort of employee, it's your number two who's going to take it over. A lot of times we'll see in the trust administration context, somebody will say, my business is going to go to my longest serving employee, Joe. He's been great and he can certainly take it over. Well, upon death, what we do is we have to get a valuation of the business so that the IRS knows the value of the business going to Joe. Joe now has to be able to manage a business with that value attached to it. So a lot of times we see these fail because there isn't some sort of insurance policy in place to allow a buyout. So again, we see it all the time. It's, I want my business to go to my employee. He just needs to buy my wife out. If there's no money to do that, when the valuation comes in and the valuation is way higher than the liquidity that this employee has, the business sale falls apart. And unfortunately, what happens is there's usually not another good candidate to take that over. So what we do is we set up a buy-sell agreement and we fund the buy-sell agreement. So we'll have some sort of insurance policy in place so that your key employees can buy your family out so that your family gets some sort of liquidity upon your death. The other context that we talk about insurance in is continuity of salary. So everybody in here, whether you're a business owner or an employee, your family may in some way rely on your salary. So if you were to pass tomorrow, what would happen? How would the bills get paid? All of that. So one of the first things that we often see recommended from financial advisors is we need some sort of life insurance. That's especially important if you have a substantial role in a business, so you can make sure your family has continuity of salary. And then training and development. So another big miss we'll see is when people don't properly train who's next in line. So that's another plan that we like to see put in place. Fragmented leadership is another big one. We see this in not just succession planning, but in estate planning in general. If you have an asset, especially a business, you want to pass it to the next generation. If you have 4 kids, it's probably not a good idea for all 4 of them to co-run it. So we do a lot of thinking around what should your succession plan say about who has what role. Maybe all 4 kids have some sort of ownership interest, but you designate one of them as being in charge in one way or another. Too much secrecy, that's another reason we see a succession plan fail. If nobody knows about it, there's nobody to explain the rationale about it once you've passed. So we often encourage clients, draft your succession plan, have a very clear plan of what's going to happen when you pass, but you need to make sure that the key people who are going to be taking over know that. Do some internal politicking to make sure the employees know that too. These are kind of some things that I see missed in the succession plans that we help clients with. One, passwords. This is huge. Who knows the passwords to your QuickBooks? Who knows the passwords to your HR system, your ADP or whatever it is you use? We'll see a big lag in getting paychecks out because people just don't know how to log into the system. So make sure that you have that all squared away. Who knows the location of your files, business assets, contracts, accounts? That's another big one. So if we say, okay, what do the bylaws say about who takes over next? We can't find the bylaws, we're in a little bit of trouble, right? So making sure somebody at least knows where all those are. Even if you don't have a business or work in a role where you think, okay, there's, this isn't some business that's gonna have this big succession plan. I'm not, running a dynasty here. Who's gonna make sure that everything gets locked up and safe, right? So they have to know where everything is. Keeping a current ledger of any accounts receivable. If somebody owes the business money, make sure that's documented somewhere. Sole proprietors in particular, we found are a little bit loose about this of, I did an event with these people 3 months ago. I know that they still owe me money, but that's not written down anywhere. So make sure that you're keeping that current. I had a client 2 years ago who her husband was a private pilot. And she started getting all these calls of, oh, he actually didn't pay me. And we had to do a lot of work of figuring out which of those claims were valid and which were just completely bogus. Turned out every single one of them was completely bogus. They were just trying to take advantage of the fact that they knew she just got a life insurance payout. But he hadn't done a good job of keeping a list of who owed him money and who he owed money to. So it took us a very long time, and it was really stressful for her trying to figure that out. So make sure you have a very, very good note-taking system of who owes who what. And documenting key workflows, making sure that people know, okay, when it's the 15th of the month, I do this, I tell this person to do this. Even again, if you're not planning on passing a business down to somebody, this is something that even as an employee, you need to make sure you do. You need to make sure that everybody who would be taking over for you would understand what you need to do. Who have you equipped to carry on your duties? It's wonderful to be irreplaceable until you are actually irreplaceable. So make sure that there is somebody who at least has some breadcrumbs to understand where to go, to understand how you do what it is you do. We do a lot of planning with our family businesses of when is the right time to pass on your business, all based on tax planning. So what's the value of your business now? What's your basis in your business right now? What's the value of your business in 2 years, 5 years, 10 years? Next year is going to be a wild year for exactly this, because on January 1st, 2026, the federal exemption from estate tax is going to be cut in half. So right now it's 13.61 million each that we can pass on to the next generation without the 40% tax being applied on those assets. But come January 1st, 2026, that'll be cut in half. Unless a change is made by Congress. But next year, a lot of people are going to be making a lot of these big transfers of assets because of that. So when we think about tax planning, cocktail party knowledge, that's going to be a hot topic next year.
So you go to probate, but you're talking about all these different assets. How do you find the assets? And how do you freeze them? How does that work?
Yeah, that's actually a huge problem because a lot of times people who are going through probate aren't planners. And so people don't know where everything is. The best we can do is we watch the mail or email. Beatrix just worked on this for me. There are account recovery contacts on emails that you can do. So you give a death certificate to Google and say, I need access, because then you'll see bills start coming through or account statements start coming through. So that gives us a clue. The other thing we do is we go to the California State Controller's website, and there's an unclaimed property search on there. So if there's anything that's been turned over to the state because nobody claimed it, it'll be on there. I would encourage you this afternoon, go do it for yourself. I have like 3 things on there that I haven't taken the time to get. It's like $12. If you were in college and for me, it was a long time ago, and I was owed a refund from my final utility bill, and I had moved, so they sent it to my address, and I never cashed the check. They give it to the state controller's office. So we look there too. But that's a huge issue. And yes, the accounts are frozen. So that's one thing that's a big point of stress for families is they'll come in and say, we're going to do a probate, but I know the second I notify Bank of America that my husband has passed, the account will be frozen. True. So usually we'll be able to find access to some account that the person already kind of has a backdoor way into, but they do freeze it until we get access to it through the probate court. Actually, in Avila, we had that issue where Mr. Avila's mortgage went into default because he was paying the bill and we couldn't get access to the account. So I contacted the mortgage company and I said, hey, we're going to probate, but we submitted our petition for probate in September. Our hearing date isn't until next June or something. So can you just hold off on foreclosing until we get in front of the probate court? And they said, no, we're going to foreclose on the house. So what we had to do is you can go to the court and ask for emergency relief and say, give me access to just that one account. But it gets kind of even more uncomfortable than normal because you have to give full financial histories and prove to them that there's a reason you need access to the account. Yeah, Lisa?
I have this so you were talking about the good housekeeping matters,
Yeah,
and that was pertaining towards businesses, but
Yeah.
immediately I was thinking of, like, our parents.
yeah,
We had that uncomfortable conversation with them about 10 years ago, my father's retired, but
yeah,
if something were to happen, please make sure you have everything, and he has a trust.
yeah,
But we kind of along the lines where you were mentioning about passwords and stuff, I mean,
Yeah.
we asked, please, like, my father finally,
Yeah.
after I was bugging him, he
Yeah.
finally put something out, because I'm like, I need to know where your safe deposit key is, where's this?
Yeah.
And a lot of the stuff is like, oh, call so-and-so, like his best
Right,
friend.
right.
He'll tell you where, but.
Yeah.
But finally I told him, I'm like, put it in a sealed envelope, and I promise I'm not gonna open it, but
Yeah.
just put it in, we'll put it in the safe.
right,
But that was done so many years ago, I know we need to revisit that.
yeah.
But the passwords to the
Yeah.
cards and all that stuff, I'm assuming that we should probably be doing that with.
Yeah, just as a person. Yeah. And that's, again, that's what Beatrix and I were just working on. She's our intern, and we're working on that, a pamphlet to put in everybody's estate plan to say, great, you secured all your financial accounts, but what about your iCloud photos? So what there is for each kind of digital asset, there's usually some sort of account recovery or trusted contact. Apple has a trusted contact. So you can say, I designate, I think I have my sister designated. If something happens to me, she can get into it, that kind of thing. So definitely do that. For passwords, there's this program called LastPass. It's a website that I've been told, incredibly secure, but it keeps current all of your passwords. And then what happens is you show a death certificate upon the death, and then that person gets access to all of the passwords, and it auto updates as you update your passwords. So it's a really nice tool. The biggest one is the code to your phone. So there is a procedure through the court that we can get Apple to get access to the phone, but it's not easy and it's not cheap. So just,
Based on what you were saying about people who moved out of California, so many people are doing that. Do they have to redo their trust in whatever state they are?
yes, but we have a lot of clients leaving. What we always tell them though is you don't have to change the name of your trust, which sounds minor, but like I said, the most tedious part of your estate plan is funding your trust. So what they do is they go to an attorney in the new state and they restate their trust in that state. Usually the trust will say substantively the same thing, the name will be the same, it just is in accordance with that out-of-state law. And usually if they're leaving, there's a good reason for it and it's permanent and maybe tax-driven, and so we're telling them, oh yeah, get that.
International assets, like housing abroad, like
Yeah.
living in Europe, or like houses out there, and then international bank accounts, like what about that?
Those are tough. We can't capture those. You can always have them point to the California-based trust, but we can't actually go out and grab them, if that makes sense.
Just curious about the $180,000 threshold.
Yeah.
What if the assets are under that?
Mhm.
Do they go through probate? How does that work?
No. So there's what we call a small estate affidavit. People also refer to as a 13100. That's just the probate code it's based on. All that is it says, okay, I hereby declare, if you added up everything I own in the world, it's less than 184,500. So please go ahead and give that asset to my legal heirs. So no need for probate. But we always tell clients, if you have assets that are getting close to that number, a lot of institutions will start questioning it because it's just a piece of paper that you're signing. You're saying, I certify under penalty of perjury that I own, or my loved one owns less than this. So we always tell our clients, make sure it's well under that. Like if your account's at 175, Bank of America is probably still going to freeze that account.
All right, well, let's give Brittany a round of applause. Isn't that amazing?
Thank you.
I know I was a lot, for sure.